How do, fellow financial independence seekers? Welcome back to another episode of Trade in Your Job with Matt. And today we'll be looking at two ETFs. One is from popular YouTube star Meet Kevin, and that is ticker symbol PP, and that stands for Meet Kevin's Pricing Power ETF. And then we'll also look at XLK, and that's the SPDR State Street Global Advisors Select Technology ETF. And that's been around since 1998, so a little more history on that one. And we'll look at some of the differences and some of the holdings in those, and we'll look at maybe which one you should consider long-term for your portfolio. For the record, I don't have anything against Meet Kevin. He is a wildly successful individual. He's run for public office. He's got a lot of things going, hands in many pots. So if you feel very strongly about him, this isn't meant to put him down. So if you're not familiar with Meet Kevin, he is a YouTube star, but also dabbled in real estate, and that's where he says that he made most of his money before he became a YouTube sensation. He's tried a number of different ventures. I think he ran for public office recently, and he's also now a portfolio manager. And website that we're on is mketf.com, Meet Kevin Pricing Power ETF. But at any rate, in November of 2022, he started this ETF, and I thought it'd be worth looking at. It does have a decently high expense ratio, 0.77%. And the goal of the fund is that it seeks long-term capital appreciation. And he does this by buying US-based innovative companies. How do they define innovative? Well, it sounds a lot like how Cathie Wood and ARK defines it and what they're looking for: new product services, tech advancements, consumer engagement, and disruptive approaches. And then for the pricing power portion of it, they're going to invest in innovative companies that, in Kevin's view, also have more pricing power than their peers. And what does pricing power mean? It means that if the company were to raise their prices, the demand would not falter. They could raise their prices without a subsequent fall in demand. Warren Buffett often talks about this, is that, if you have a good enough moat, that you can have price control. And you see this with products that people need to buy, like consumer staples. Prices of a lot of things went up due to inflation and people kept buying them. That's price inelasticity. It means that people will buy it regardless of what the price is. So Meet Kevin ETF is trying to capitalize on things that he believes people will buy no matter what. But a lot of the holdings are price elastic holdings, so I don't know if that's really going to hold water as we move into a sustained period of money being more expensive. As for the performance of his fund, it's obviously done pretty well. The since inception cumulative return, 21.85%, and year to date, up 38%. I mean, those are really great numbers. And that's as of May 31st. It's up even a little bit higher than that since then. You can see the top holdings here, and Meet Kevin's been a big proponent of Tesla for a long time, and that is a very heavily weighted portion of this portfolio. And then you got Apple. But these two alone are about, 40% of the portfolio, pretty heavily weighted compared to other things out there. Then just looking at the chart since inception at the end of November, you can see that it didn't start out too strong. Had a nice sell-off into 2023, and then just ramped and then consolidated and then exploded upward. Right now, you've got some negative divergences happening on the channel commodity index pointing down, relative strength index pointing down, and MACD just got a sell signal a little bit ago. Slow stochastics also pointing down. So if you were looking for an entry on this, then might not be the best time to do that. You want to wait until things are oversold down here on the channel commodity index before you start considering adding. So I went to my portfolio visualizer favorite tool here and went to month, starting with $10,000 if there was any income, which, this is focused on capital appreciation, not really income. Plugged in, Meet Kevin's Pricing Power ETF, ARKK, which is Cathie Wood's Innovation ETF, and then XLK, which is just the technology sector SPDR. And I put each one at 100% for the portfolios to analyze all three. And when we get down here to the portfolio summary, you can see that the returns for all of them were positive, and the technology sector XLK returned 21.45%, and that far outpaced Meet Kevin Pricing Power 17.51%. That's since inception of Meet Kevin's fund. You got Cathie Wood, who's actually the worst. And then when you look at the worst year, I think that's the one that stands out to me. So there's less drawdown on the technology sector SPDR XLK, and there's more upside. And then the Sharpe ratio is over 1, which tells you that, that is a good investment comparatively. These that are under 1, not doing so great. And then in the annual returns, we're just talking about that month there, went down less, and it hasn't gone up as much for the year, but the fact that it goes down less is why it's ahead. And then XLK does distribute income, the other two have not. So now let's go over to the State Street Global Advisors website and look at XLK and see why that one might not go down as much and might be a better long-term hold for you. The first thing I noticed is the expense ratio is 0.67 less at 0.10. It's got significantly more assets under management, obviously since it's been around since 1998, a lot more time and a lot more notoriety. As far as innovation, it's investing in companies that are in tech hardware, storage peripherals, software, communications, semiconductors equipment, IT services, electronic equipment, instruments, and components. So all the things related to innovation and all of the things needed to power the innovation companies. Does distribute dividends on a quarterly basis. And then in the characteristics, the number of holdings is 65. It has significantly more holdings than the pricing power ETF. And what does that mean? That means more diversification. And then looking at the performance, you can see really positive. Since inception, it gives us the numbers down here, 8.39%. Since this inception date was 1998, you can see how outsized the performance has been in recent years because it hasn't really moved this 8.39% up, but all of these more recent numbers are significantly higher. So a lot of the outsized performance has happened recently. Will that continue? It seems that tech would be a place where that would continue. Have there been times in the past when tech has been in a bubble and has reset? Obviously, the answer is yes. Could that be happening now with a lot of these things that have been hyped and haven't really panned out? Definitely. So just be cautious before dumping a lot of money in here based on recent performance. Don't let recency bias get your portfolio in trouble. As far as the top holdings, they're just going to follow the index top holdings, and these are also very heavily weighted. These are 20, almost 25% each, so 50% of the portfolio in two holdings, Microsoft and Apple. That's different than the pricing power ETF, which had a significant portion in Tesla. So could XLK take a big hit? Absolutely. If Microsoft and Apple were to lose some of their strength, that would definitely hurt. Nvidia at 5% isn't making up a huge portion, but obviously these three have had really stellar performance so far this year, which would explain why XLK is up so much. Here's the first top holding for Microsoft in XLK. You can see really strong uptrend for the year. And same thing for Apple. Bottom of the chart here on the daily time frame was pretty much the new year and just been on a monster run here so far in 2023. So in conclusion, if you were going to heavily weight tech in your portfolio or overweight it compared to the total market, then I think XLK is a little bit better way to go. It's more diversified, it gives you more holdings, it's more index-based, and the costs are lower. It's not to say Meet Kevin's pricing power ETF couldn't outperform XLK over the next 10 years, but the costs are something that we can control, and we try and control those whenever we can. If you like XLK or if you like PP, let me know in the comments why. I'd like to hear your perspectives on both of these. And if there are any other ETFs that you've been interested in purchasing or would like to have me review, I'm happy to look into those for you. Please leave a comment. As always, thanks for watching. Till next time.